TheoTrade. This is Don Kaufman. July 1st, 2022. We are just seconds after the cash close here on this Friday afternoon, headed in, of course, to the July 4th holiday weekend. An absolutely catastrophic first half. But the big question is there more to come? We're going to answer that and much more here on this weekend's update. First and foremost, a little kind of week in review as the SPUZ. If you're unfamiliar with the terminology of SPUZ, means the S&P futures contract hanging on by a thread right now. What do I mean? Well, that has to deal with in context of the SPX expected move. If you missed this week of trade, really only one day of dramatic sell side, of course, transpired on Tuesday of this week. But let's get more specific and cruise right over to the SPX. So week in and week out, of course, I have been discussing what have been a monstrosity of 2 sigma moves inside of the S&Ps. There's 2 sigma move, another 2 sigma move, 2 sigma move, 2 sigma move. So really in the last few weeks, you've had 4 out of the last 5 weeks with these just wild and woolly moves, meaning that, the marketplace, for instance, was expecting like a 130-point move. Instead of moving 130 points, it moved 260 points. And again, those expected moves are predicated from the, and it's all derived from, of course, the option premiums, right? So it's an averaging of the option premium. This week, we had plus or minus approximately $112 expected move. And oh, wow, it came down to it. When I say that the S&Ps are just holding on by a thread, like it's not a joke. It got edgy both Thursday and Friday. In fact, to get into specifics of trade and why we talk incessantly about expected move, all you're looking at on your screen right now, in fact, I'm even going to collapse this left side bar because it's just incredible. This is Thursday's trading session. We broke lower off the edge of the expected move, right back to it. This, all right, the line across your screen, that is the lower edge of the expected move. That's precisely $112 lower than we started, okay? And you can see that the S&Ps are hanging on to it. All right, this morning we actually opened slightly below it. We break right into it. I mean, again, hanging on by a thread. This trade today, let's, not per se call it a rally back by any stretch of the imagination. You're 25 points north of the edge of the lower edge, I should say, of the expected move. That's what I would actually constitute as hanging on by a thread. You can also take a look around at like SKEWs and actually apply auto expected moves. The auto expected moves, what it basically does is it's a script built into thinkorswim that kind of calculates the expected move. It's not nearly as definitively accurate, if you will, as the hand-drawn expected moves I put on the SPX, but the QQQ is outside the expected move. You're taking a look at the Russell's just slightly inside the expected move. Like this was, I wouldn't call it per se like a pivotal week of trade, but we're hanging on by a thread right now, and that is one of the largest kind of takeaways from there. So to kind of continue on, and again, I'm not really going to do much of a recap here because it's over, it's done with. Like we've had these, 2 sigma moves. You can see the SPX is all kinds of inefficient. And I don't use that term again lightly. When I say, the SPX and the options in the SPX, listen, this is the mother of all products. I say this each and every week. Why do we look at the SPX? Well, look at the SPX because it did 2 million contracts today. You go, oh, whatever, 2 million contracts, not that much, right? Well, let's compare it, for example, to Apple, which is one of the most liquid, equity products. Apple did 1 million contracts. The only difference is the SPX, of course, in terms of notional value, is almost a $4,000 product. Okay, So the SPX does 2 million contracts. You look over at the spiders. What are the spiders doing? The spiders did, 7.6 million. Do you realize the spiders are almost the exact same thing as the SPX? But then if you add up the SPX contracts and the spider contracts, and of course, let's just throw VIX in there because VIX is usually good for about 500,000. A little light today, but okay, you're up to about 10 million contracts just between SPX, VIX, and SPY. What does it equal? 1/4 of the entire trading volume of the entire marketplace is through SPX, SPY, and VIX. All right, and that doesn't even count the fact that S&P options on futures are now very readily traded. Like there's 500,000 contracts S&P options and futures. All right, we're talking now trillions of dollars of liquidity going through the SPX every single day. When I tell you that this thing's hanging on by a thread, ooh, it's getting dangerous. All right, let's move beyond it. Again, I said there's no reason to kind of rehash. We're just off some of the recent lows. 36.39 is actually the recent low. You might say, hey, no, man, we're like 200 S&P points higher. Yeah, that's a hop, skip, and a jump off some of the recent lows. And there's a lot of headwinds, and I'm going to talk extensively about some of the headwinds facing the market. One of the things that is bothersome at this point in time is the dollar. So the dollar today was almost to the point of actually breaking to the upside. It did fade. This is something unequivocally worth watching in the days to come. The strong dollar. First of all, it's keeping metals down. Like I've actually been rather bullish lately in some of the metals. You know, boy, you can't be more wrong than that. And this is really only like the last month or so. I've been rather bullish in metals. Metals, they're not crashing and burning like a lot of products are, but they're definitely fading. So this is worth noting. Strong dollar is keeping the metals down, but there's another reason that I'm mentioning the strong dollar because pretty much since right in the beginning of the year, if you take a look at the dollar on a year-to-date basis, it's up almost 10%, which is just a phenomenal size move. And pretty much the sell-side activity in the S&Ps, well, that kicked off right at the front of the year, and the S&Ps, of course, are down about 20% halfway through the year. Anyway, with that being said, so it does appear that the dollar is being used, okay, as some type of a risk mitigation tactic against the S&Ps, or you can, basically, surmise that, hey, listen, world economy isn't doing that good. Where does everybody dive into? They dive into US dollar because in the end, our crappy dollar is better than their crappy dollar. I mean, we've spent like the last 40 years in the US propping up the dollar, but if you take a look at the euro is not too far from being almost at par with the dollar. Now, depending upon how long you have been alive, okay, that's a 15-year. I got to open up the max chart here. Depending upon how long you've been alive, many of us have not necessarily seen this too many times in our lifetime that you can actually say a euro is worth almost the same as the dollar. But that's exactly where I'm not going with this. Where I'm going with this is not so much the weakness inside of the euro. Where I'm actually going with this is the yen. And I think that this is going to scream problem in here. If we do take a look, albeit briefly, at the Japanese yen, something I was questioning earlier today while I was live on TheoTrade is at what point are we actually going to say that the yen has completely collapsed and Japan is not just in trouble, but you're looking at possibility of a collapsed economy at this point in time. Pay very careful attention to this into the second half. And that's one of the things that I want to give not just like a look into this next week of trade. One of the things I want to bring to the table here is the next couple of weeks, the next few months, there's not enough people paying attention right now to what's going on in the world of currencies. This is the largest moves that any of us have ever seen. Okay, this is an absolutely decimation of the Japanese yen. There's no if, and, or but about it. And of course, we can talk in depth. Blake Young is kind of our currency specialist here and FX specialist here at TheoTrade. And Blake, of course, can get into detail about the carry trade in here, but there is just no end right now in sight for the weakness in the yen. Careful eye on this. Again, in the days and weeks to come, I believe we're actually going to start to hear about major issues that are surfacing inside of the yen, one of which did surface, in fact, today, and that is Apple raised prices by 20%. Did they really raise prices? It's inflation. It has nothing to do with that. It has to do with the currency that's absolutely collapsing at this point in time. Again, not only we're going to be watching the Japanese yen, but the EWJ, of course, which is the ETF associated with it. Here's the irony. It's down about 20% a year-to-date basis, which is almost in line with the S&Ps, onward and upward from there. Beyond the strength in the dollar, which again, strength in the dollar, I actually look at as hedging activity for what could be a weak S&P. The next thing I want to focus on is, well, this actually surprised me. Let's actually cruise over to the TLT, come over here into apply auto expected moves. A rip and rally has gripped hold inside of the bond market really like the last 2 weeks, right? And again, sometimes I'm more comfortable looking at the TLT. Some people are not exactly as familiar with the bond market. So question being, everybody's talking about rising rates. The last time I looked, a rally inside of the bonds will lead to, well, take a look at the TNX. Okay, rates are collapsing right now. So you gotta look at this and think to yourself, what's going on? Well, number one, it really could be an inversion of the yield curve, and but I think that's not even secondary. It's probably tertiary. There are two major factors in this bond rally that I would actually pay attention to. Number one, okay, longer term rates, which is the ZB and the ZN. The ZN is the 10-year, the ZB, of course, 30-year. Longer term, I think it's just actually deflationary. I think we're going back for an inverted yield curve. Yeah, but it's deflationary. That is not exactly bode well for the marketplace as a whole. Number two, and this is much shorter term. So deflationary is looking out into the future, right? It's looking out, 3 months, 6 months. For the most part, I also think to myself, it's deflationary. That means the Fed is barely going to get this thing off the ground, meaning the Fed's at 1.5%. What, you think they're really going to get to 5 or 6%? We're going to collapse way before that. So the second thing about the bond rally that I really think this is much more short term. This could be a hedge for traders anticipating more risk. So you pick. Is it just wildly deflationary? It's got to be, right? Or is it just a hedge? The answer is it's probably a little bit of both. But all of a sudden, you got to be concerned when a product that nobody wants to touch. I mean, the bonds have crashed and burned. Yeah, then they start to rally. And you go, wow, but maybe that's good because the rates are going to come down. But they're not going to come down because the Fed is going to keep the pedal on the accelerator and keep quantitative tightening going. All right, with that, so that is a huge issue facing the marketplace. Strong dollar, can't be warm and fuzzy about that. Strong bonds, can't be warm and fuzzy about that. Volatility issues are still very, very prevalent. When I'm talking about volatility issues, I'm talking about things like, I'll start with the volatility futures, right? So, I'm talking about like low SKEW, low VVIX, volatility futures are not in backwardation. You realize like in a trading session like we had this week, stuff got pretty crazy. Look at this, 19-day vol futures versus 47-day vol futures. I mean, we're still, 60, 70, even 80 cents into contango. And for those of you that don't speak geek, it's a contango, it's a backwardation. Listen, when short-term volatility exceeds longer-term volatility, it's just, all it screams is, it's on. That's when the marketplace is just raging in volatility. And what's crazy, though, is, you see the S&Ps, they come down, and we came within what? Let's say, less than 200 points from the bottom of the marketplace, and volatility just went, shrugged its shoulders. Like, that doesn't make me feel warm and fuzzy. And when I say that there's still issues with SKEW and VVIX, look, the VVIX, the volatility index, this kind of dictates who's hedging, who's not. It's one of the lowest VVIXs we have seen. I don't like it. I don't have to like it. I am not going to like it. Effectively, what it says, there's nobody hedging right now in VIX. If they're not hedging in VIX, where are they hedging? Okay, you look at something like SKEW. Now, SKEW is really weird because they only calculate at the end of the day, but SKEW is absolutely rock bottom at this point. What does that say? Nobody's buying out of the money puts to hedge. Nobody's buying out of the money calls and VIX to hedge. What are they doing? The answer is absolutely nothing. Ooh, it's not good. And we're not in backwardation right now. It's incredible complacency with the marketplace that's selling off. And again, I just don't think that bodes well for the future. All right, let's compound some of the issues over here. Listen, I don't mean to come into the holiday weekend and be an outright bear, but everything you look at right now is just, it's significant headwinds. Everything we're looking at is significant headwinds. Like, you show me some bright spots in here, because now I'm going to get to one of the more interesting things that I don't necessarily always talk about. The lowering of guidance. This is something that could shock markets. I think it's actually coming this next week. So earnings are coming. Earnings are coming. We can argue that Microsoft already kind of guided a little bit lower because during their last, major earnings announcement and call, they did in certain sectors of the business guide a little bit lower. One of the things you got to start to think about, if anybody has got anything to say about lowered guidance, they got to do it now. They got to do it before their earnings announcement, or they could be, held liable. Again, you have fiduciary responsibility to the shareholder. I'm not saying per se Microsoft, but if you cruise over to something like Facebook, okay, Facebook today actually announced there's probably going to be decent layoffs, and that they're going to face one of the most difficult times in the company's history. And that doesn't come from me. That comes from Zuck himself. So Meta right now looking for the possibility of significant layoffs. Okay, I know that's not exciting stuff, but again, here's the reality. So you just finished the first half. Why is that important when it comes to lowering guidance or warning, if you will? If you're a major S&P 500 company, you do want to wait until the statements get mailed on June 30th. Think about it. The statement gets mailed. What do I mean by that? Everybody knows, like mutual fund managers, they window dress. And effectively what I'm saying in this context here is that right after June 30th, it's open season on if you're going to have bad news, it's coming next week. So be aware. There could be warnings anywhere and everywhere inside of the S&P 500. Today, we actually heard from the likes of General Motors. So General Motors did actually warn, had to do with like the chip and the slowdown and so forth. But ironically, the stock finished up. But if you haven't looked at General Motors lately, a lot of this was probably priced in. The stock is down almost 50% on a year-to-date basis. Moo! Micron actually warned. Okay, Micron warned. They're down almost similarly, but this was actually a warning that was done during the earnings announcement. Restoration Hardware, which is actually luxury furniture, significant warning yesterday. The stock has been pummeled now. It's down about 60% on a year-to-date basis. Obviously, we just talked about Facebook, which is Meta. Netflix, actually, subscriber growth has warned, and Coin, significant layoffs, and has warned. Those are just a handful, and I recognize that there are many, many more warnings, but I am telling you, okay, just in the next week and a half before the earnings come out, you may get actually a slew of warnings. Okay. Other than that, they would have to do it during the earnings announcement, which is very, very risque. Of course, if you were on the board of directors. All right. Continuing on over here, as I said, there's significant headwinds shall prevail in the second half. I mean, again, we had a catastrophic, first half. There's no resolution in sight. Okay. The thing that I think really resonates with me much more as a quantitative trader is that, again, we're coming into a holiday weekend. Volume is decent inside of the S&Ps, but I'm put off by the fact that volatility refuses to rage. There are signs that I think need to be there for degrees of capitulation. One of which is, higher volatility. Another one is we haven't seen really too many bankruptcies or consolidation within different industries and different sectors. All right, what I'm basically getting at here is, listen, it's a long road at this point in time. Last but definitely not least, take a look at the SPX. The SPX, we're going to come into a 4-day trading week. Again, U.S. equity markets and futures markets are closed on Monday, of course, for the July 4th holiday. So we're going to come into a 4-day trading week with the Friday expiration. We're looking at about a $94 expected move. Now, we just came off of a $112 expected move. Of course, that was in a full 5-day trading week. And what did we move? We moved every ounce of that $112, even outside of it, and pulled back up into it. $94 expected move. I would say keep your hands and feet inside of the vehicle at all times. This is going to be, again, a very, very rough summer of trade. Volatility, it's not going to subside. So you have to anticipate as a trader, like, forget about your directional bias per se on a day-to-day basis. I know that that's hard for some people. You know, if you're scalping, you're in the moment. When you're scalping and you're trading on an intraday basis, you're in the moment, pick up a trend, that's phenomenal. But those that are actually trying to handicap overall moves in the market, okay, you're going to have to be steadfast. You're basically just going to have to wait for, for the move. I've got some both bullish and bearish positions on, but on a much bigger sense, I'm still selling premium. I'm selling back month premium. Short-term premium is horrifically priced. In my opinion, it's when I say short-term premium is horrifically priced, look out in the short term over here. Look like 7 days out. You're getting paid like 22 vol, 24 vol. You got to come out a distance here. Now you're getting close to like, 28, almost a 30 vol out in back month premium. That's good. That's some juice. Up front over here, it's absolutely horrifying that people are selling short dated options. And I'll tell you exactly why. If you look in the shorter term, and I'm actually going to bring up the SPX for this. You look in the shorter term, you go over here to studies, go add study, go volatility studies, and you bring up historical volatility. Historical volatility is the annualized standard deviation of past stock price movement. Average over the last 20 days, historical volatility is actually raging at the tune of almost 30%. 30%. You know what the VIX is at? 26. That tell you something? You sell short-term premium, okay? You're going to die trying. Think about that for a second, all right? Actual price movement, which is realized volatility, or what we term historical volatility, is close to 30%. Okay, implied, which is what we are, the implication moving forward, is right now dramatically less than that, but average over the last 20 days is still less than that. Short-term premium is not the place to be. You better be selling back month premium or you are going to get run over by this marketplace. Again, the way to survive, sell premium, mitigate risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.